Hey, greetings and welcome to the February 2025 Investment Strategy Brief. In this session, I basically want to we'll give an update on what's going on, but basically want to get into the changes in Washington, D.C. We're seeing a lot of investors, a lot of clients that are really optimistic about the changes. We have a number as well, though, that are pessimistic. So I want to get into that and sort of frame it against our outlook a little bit. But anyway, let's jump into it. Just to start there, just to remind you, last month we published our outlook, what we called Outlook 2025 Gravitational Shifts, with quite a number of articles available in the Outlook report, right? And so we invite you to check that out. You can go to stiefelinsights.com and check out the report and a video and so on. But again, I want to kind of provide an update on the environment and then get into that idea of what to think about what's going on in D.C. So starting with geopolitics, I think we all know, just to take a step back and take a quick look at the Trump administration, the 2.0 Trump administration. We know there's deregulation, a focus on taxes, on healthcare, on military and defense, on foreign policy, a shift in energy, sort of banter about where interest rates should be in terms of the Fed, and then a focus on efficiency, government spending, and all of this leading to and influencing animal spirits, which is the driver in some ways of both our economy and our markets. And so, again, in a moment, we're going to get into that from a couple different perspectives. To take a step back, though, and look at the economic environment, and the economic environment for the time being remains pretty positive. So we've seen GDP, the solid line, get back to trend growth recently after the shutdown from the pandemic. This chart always reminds us that the consumer makes up about 2/3 of GDP. And, bottom line is that we've seen some shifts with the consumer. Retail sales for a while was bumping above the long-term average, but recently, basically, we had a more than negative than expected report. So that's something everyone's going to keep an eye on, and some nervousness basically that's kicked in. We know that's especially true for lower income folks who are being pinched a little bit by inflation, but as well higher interest rates, higher cost on debt. All of that against a backdrop of what continues to be a strong labor market. So again, mixed signals for the consumer, something that we'll keep an eye on. When it comes to businesses, as we looked at last time, especially small businesses in the U.S., there's optimism kind of seen as a result of the election. So this chart, the NFIB Small Business Optimism Index, basically shows us 2024 and the big jump that happened in the election. We can compare that to what it looked like in 2016. And so again, generally speaking, there's been optimism in the business environment. But I mentioned inflation. And one of the things we're keeping a close eye on is both the consumer price index, CPI, and the producer price index has surged a bit in recent months, right? And so that green line on this chart represents the monthly equivalent of the Fed's 2% target. And we want to see those bars, these happen to be rolling 3-month averages, down around that green line. But you can see recently that they've sort of tipped higher. So the inflation reports have been firmer than expected. It certainly has the Fed's attention. And how that's translated between inflation itself and the unknowns of this next administration. Basically, what's priced into the market currently is just one more quarter point cut later in the year. And you can see this chart. Then we've sort of evolved it to a stepwise thing. You can see, quarter or half point, whatever ends up happening. And you can see that the blue line represented the optimism back in September, and that's really muted, right? So there's just this expectation that the Fed won't act too quickly or too much in 2025. Now, obviously, we've talked a lot about interest rates. We've talked a lot about debt. We talked about fiscal transition and the trajectory we're seeing with the deficit here in the U.S. and whatnot. And the punchline here is the markets still are signaling higher interest rates for longer. So the 10-year Treasury now sitting in round numbers around 4.5%, but expected to be there or even higher than that over the next 10 to 20 years. That means higher cost of debt. So when we think of the buildup in debt across our economy, households, companies, the federal government, of course, since the financial crisis, all of a sudden this cost of debt is coming into focus. And so for sure, the idea of government efficiency is going to play into this, and the idea of wanting to drive the economy stronger to sort of outgrow the debt, if you will. But the bottom line is we see both government and corporate officials increasingly talking about the importance of fiscal transition to a stronger debt situation, especially in the U.S. Now, as it relates to the overarching view on the economy for 2025, the consensus is for a continued positive results, the consensus being at about 2.2% for the full year. And we're sort of in that neighborhood. I think we assume GDP will land somewhere between 1.5% and 2.5%. That's my part of the organization. Our colleague, Dr. Lindsay PX, is actually a little bit more optimistic. She has a 2025 forecast of 2.7%. In any event, I think my primary takeaway is no recession and continued pretty strong economic growth is the outlook. And that's sort of set up for a strong market. First, to start with interest rates. Basically, we've seen a normalizing of the Treasury curve, meaning that longer rates are higher than shorter rates. And rates, again, bumping up and being certainly a lot higher than where they were at the lows of the pandemic, for example. And with that bellwether 10-year yield at roughly 4.5%. Our view is that rates will stay in a half-point range, sort of 4.25 to 4.75, but especially end the year somewhere in that range. And there are forces at work, right? There's the idea of the Fed keeping rates higher for longer. There's the idea that if people start to question federal debt, then they're going to expect to be paid more to hold that debt. That's an increase in what's called the term premium, the premium you get to hold the bonds. And so there are these forces that are certainly keeping interest rates higher for the time being. In any event, that translates to higher yields looking forward for bond investors really across all the various categories. So those higher yields have been maintained in terms of the bond market. And so it remains a good time to either maintain or reestablish your longer-term strategy that might include fixed income. It's a good time to have that and to be doing that. One of the reasons, by the way, is diversification. So when we switch over and look at equities, basically equities remain really elevated in terms of valuation on a cap-weighted basis. And so the premium, if you will, to PE ratio, the long-term PE ratio is about 27%. But when we look at it on an equal weighted basis, things are reasonably fair in value. And so what that tells us is we expect a broadening of the market, not just the biggest companies to be doing well, but there's opportunity really in the broader equity market, both in the U.S. and outside the U.S. So that's, again, another one of our themes as we look forward. We do update each session, a look at the Magnificent Seven, such a dramatic set of performance from these stocks. And the bottom line is, as we saw last time, there is a recognition and a sort of an estimation that earnings by analysts, that earnings are not going to be quite as positive for the Magnificent Seven as might have been thought sort of at the peak of last year. And so when we look at their PE multiples and adjust for that growth, basically the PEG ratio is showing the Magnificent Seven a little bit overvalued relative to the rest of the market. So again, another sort of data point that reinforces this idea of broadening out. And then when we look at cumulative results, very healthy 2024, as we talked about last time. But as we look at how 2025 has started out, generally speaking, things are looking pretty good and signals a little bit of broadening, sort of a rotation from growth to value, for example, modest as it is, a rotation to include positive returns outside the U.S., which we haven't seen in a while, and the equal-weighted S&P 500 keeping up reasonably well with the cap-weighted. So again, it's early in the year, more to come, but we're seeing some interesting patterns in that regard. As it relates to our forecast for the full year, we have this sort of base case that is, by recent history, kind of muted, right? So a target on the S&P of 6,200 translates to a return of about 6.7%. We'll see where things land, but just directionally, our base case is for sort of muted positive growth in the equity market and the economy. In any event, as we've talked about before, and this is really what I want to dig on a little bit in this session, is we do have two alternative scenarios. We have a bear case, which we entitled Roadblocks to Growth, where the idea is that these dramatic changes in Washington, D.C. kind of disrupt things and spook people, maybe affect animal spirits. And then the bull case is sort of the mirror image of that in the sense that investors and individuals kind of embrace the change, and we move, especially sort of fueled by artificial intelligence and things like that, to another phase of American exceptionalism. So let's dive a little bit deeper into these scenarios. So let's start with the bear case. And I'll just mention in the slides of this presentation, there are links to a couple weekly articles, one that we've done on the bear case, and then in a moment we'll look at the one on the bull case. But in the bear case, think of it as 5 different paths that we've identified. And so the first is basically an erosion of animal spirits. So even things like poor communication, sporadic communication, shifts in policy, things happen to kind of destabilize almost like the emotion of the individual and the economy, businesses in the economy, and the individual and an institutional investor. And that could cause a slowdown in the economy or the markets to turn to slow and maybe even have a correction in the market or even a bear market. Now, just to give you a sense for probabilities, we put it about a 15% chance of this kind of thing happening. And that's up against that base case, which is modestly positive. Now, that could evolve if we see weakness here in the U.S. and around the world to a global recession. And this is where troubles happen here, maybe for the animal spirits, maybe the trade tensions around the world are already challenges that we see around the world would turn the globe in a way, different countries around the world, into a recession. And that would probably be met even more negatively in terms of market returns. So think correction, recession, as I mentioned, and certainly the potential for a bear market, meaning down 20% or more on equities. Again, we're assigning about a 15% probability, and those two kind of overlap with each other, right? Now, if all that happens, or some version of that happens, we have a recession and we have still elevated inflation. That is an environment called stagflation. It's really not a good situation to be in, right? You have negative growth on the economy coupled with an erosion in value on the dollar, i.e. higher inflation. And that is something that doesn't typically happen. Usually a slowdown in the economy is met with a drop in prices. But if that were to occur, that obviously would not be well received, and we'd probably expect a more severe bear market. But note the probability. We think less than 5% chance of that happening. Now, I've talked about fiscal trajectory and the need to kind of tighten up our budget and our process. Here, if the main risk is that we ignore the problem, and we see a continued significant buildup in debt. Investors around the world start to lose confidence in the dollar as a reserve currency and in the U.S. debt as sort of a safe haven. If that were to occur, that's almost like a shift in dominance, if you will, in the U.S. capital markets or the global capital markets. And that could be met with a severe bear market, a recession, or even sort of skirting on the possibility, which I don't want to make a big deal about, but even a depression, right? These kinds of things can really shake the environment. Now, note the probability is less than 3%. We don't see this really negative unwinding to be a high probability situation. And then finally, as it relates to sort of the worry about a breakdown in the rule of law, the constitutional crisis concept, and what's happening there. The idea with this would be that these changes in the administration, there's all kinds of challenges, and maybe the court system or the balance of power or the checks and balances is probably a better phrase to use, doesn't work, right? There's failings, and either that translates to a real dysfunction of the government, or probably most notably significant civil unrest. That could really be trouble for the economy and the markets, and again, in a severe state, really cause a deep recession, et cetera, and a deep bear market. Now, here again, I'm a believer in our system generally. Therefore, I'm a believer in our checks and balances, and right now we're putting a less than 1% chance of that kind of negative economic and market scenario related to sort of reactions to constitutional crisis or unrest or things of that nature. So that's anyway the bear case. Let's turn to the bull case. And in this case, it's not so much that we're going to go through 5 different paths, but rather a bunch of different factors, which were present to some degree on that earlier slide, that we think are sort of making business owners and therefore investors optimistic. The first is deregulation, just a rollback in regulations, and the idea of things like financial services, energy, healthcare could sort of be free to do business in a more aggressive and competitive way, leading to faster expansion and better profits, basically. So that's something that people are very mindful of. We know that tax reform, lower corporate taxes, continuation of some of the 2017 tax cuts is in focus. And the idea of lower taxes to spur expansion and growth is something that people embrace, basically. Now we have mergers and acquisitions. This is the idea that there is a less of a focus on antitrust. And so the idea then is that means more deals get done. That's certainly good for financial services, but the idea of mergers or acquisitions happen a little bit more fluidly, and that inspires businesses to continue to pursue those. Really with the goal of doing better in terms of doing business. And so that's viewed, a lot of folks are viewing that positively. Now, basically, tariffs are obviously in the news. So the idea on the bull case side is that the tariff information and all this being floated and threatened and all that is really about negotiation. And this is strategic to develop stronger foreign relations, stronger trade relations for the U.S., even to the point of bringing some manufacturing back onshore into the U.S., which for the manufacturing sector locally would be a real positive. Anyway, lower energy costs through the reintroduction and sort of support of traditional energy could help in terms of improving profits, could help in terms of softening inflation. So that's in focus for sure. Now, we know there's a big focus on improving infrastructure, right? And so this can include transportation, it can include digital infrastructure, but at the heart of it, it's all about things getting done more reliably and faster, and that can improve economic efficiency, improve earnings, that kind of thing. And then I mentioned before government efficiency and fiscal discipline. So here, again, we think it's very important to focus on how can we do a better job spending the money we spend, and how can we cut back on what we spend. And so even though it's very dramatic and it's in the news and a lot of coverage, the reality is, as we make our way through, if we can get through this idea of sort of reducing spending in a methodical way that doesn't disrupt services, that obviously is kind of the ideal outcome. In any event, I would just say holistically that this is our bull case scenario. So, we actually only assign a total of a 15% probability of all this happening in such a positive way. But again, there's some possibility of that. So we wanted to share that scenario today as well. Now, looking forward, I just want to kind of close with a couple of things. I'd say we just can't help but reiterate the idea of these long-term themes and the shifting that we're seeing on the idea of applied artificial intelligence, so applied AI, and things like a focus on resources, et cetera. All of this we think is very, very important, that we're sort of evolving and the world is operating basically against these long-term themes. And what that means is we think overall the economy does better, overall the markets hold up and do well. And yet it is very much a long-term orientation, looking at these changes and how things unfold going forward. So I'll just mention, as ever, that we're focused on, a number of different sort of reports and things that we're seeing happening. It all comes in, we evaluate what's happening, and that informs these different views. It informs the way we think about investing. So keep an eye on, again, just to close out, stifelinsights.com. It's sort of the place to go if you want to check out our work. And it'll include this video and the related podcast series and slides that go with it. So thank you so much for checking out this session, and we'll see you in March. Thank you.